Tax implications of Canadian investment in a Florida rental property. Hi, my name is Allan Madan from Madan Chartered Accountant. Today, I will speak to you about the tax implications of investing in rental properties in the state of Florida, USA. The numbers. Let's begin with reviewing an income statement for the expected revenue and expenses of an example rental property in Florida. Rental income. Expenses. Insurance. Mortgage payment. Estimated based on a mortgage of $165,000, interest rate of 4%, and 30-year amortization period. Property taxes. Management fees. Management fees are not charged in the first 2 years of ownership. In year 3 and onwards, a management fee of 15% of gross monthly rents shall be charged. Utilities. Utilities are paid by the tenant. Profit and cash flow. No double tax. As a Canadian resident, you are responsible for paying Canadian income taxes on your worldwide income. To prevent double taxation, you can claim a foreign tax credit on your Canadian return for the American taxes paid. You will not be double taxed. Taxable income of the US and Canada. Let's look at the taxable income calculation for the Florida rental property for US tax purposes and Canadian tax purposes. Rental income, year 1. Expenses, year 1. Insurance. Mortgage interest. Property taxes. Management fees. Utilities. Depreciation. Based on an estimated purchase price of $220,000 with $40,000 allocated to land. Taxable income per month. Taxable income for the year. After accounting for expenses and depreciation, the taxable income for US purposes is $1,248, and for Canadian purposes is $4,188. You'll notice that the taxable income for Canadian purposes is higher because Canada provides for a lower depreciation deduction than the US. You can deduct mortgage interest expense in respect of your rental property, in addition to interest paid on a line of credit used to fund the initial down payment. The principal portion of the mortgage payment is non-deductible for tax purposes. Taxes payable. Every person receives a personal exemption of $4,050 in the US. This means that taxable income below $4,050 is tax-free. Because your expected taxable income of $1,248 is below the exemption amount, you won't owe any taxes in the US. This, of course, assumes that your only source of income in the US is from this US rental property. Note that the state of Florida does not impose a state income tax. The taxes payable in Canada in respect of the profits from your US rental property depends on your tax bracket in Canada. For example, assume that your marginal tax rate is 35% in Canada. In this case, you would pay taxes of $1,466 on $4,188 of taxable profit. Taxable income for the year. Effective tax rate. Taxes payable. Depreciation. Let's now take a closer look at how depreciation is calculated. Depreciation is a deductible expense and reduces taxes payable. For U.S. tax purposes, the cost of a property, excluding land, can be depreciated over a period of 27.5 years. However, for Canadian tax purposes, depreciation of 4% of the cost of the property, excluding land, on a declining balance scale can be claimed each year, except for the first year, which allows for a rate of only 2%. Depreciation excludes land. Withholding taxes. Non-residents that collect rents from a rental property in the U.S. are subject to a 30% withholding tax. For example, if you collect $1,500 in monthly rent, then this withholding tax amounts to $450 per month. This tax will be credited to you in full upon filing a U.S. non-resident tax return. In years 2 and onward, you will no longer have to pay a withholding tax. This is because your accountant would have obtained a U.S. tax ID number called an ITIN for you by this time. The ITIN, along with Form W-8 ECI, should be provided to your property manager so that he or she will stop withholding tax from rents paid to you. It would be nice if you could apply for an ITIN sooner, ideally when you first purchase your rental property. However, the IRS will not issue an ITIN unless the application for an ITIN is submitted with your first U.S. tax filing. The earliest that your accountant can file your first U.S. tax return is in January or February following the year of purchase. Filing a U.S. tax return. Each year, you will have to file a U.S. non-resident tax return to report the rents collected and expenses incurred. The return is due by June 15th if you are a non-resident alien living outside of the U.S. Capital gains. If you sell your property in the future for a profit, there will be a capital gain and recapture of depreciation previously claimed. Both the capital gains and recapture of depreciation must be included in your income for U.S. and Canadian tax purposes in the year of sale. For example, assume that you sell the property for $320,000 5 years from now. Based on an initial purchase price of $220,000, this means you made a profit of $100,000. The taxes payable on this profit are calculated as follows. Capital gain. Recapture. Taxes payable. Assumed total income for the year is from the property sale only. Foreign tax credit. Net taxes after foreign tax credit. The bottom line is that you will pay $17,492 of tax in the US and $3,811 of tax in Canada. The Canadian taxes are reduced by a foreign tax credit for the American taxes paid. Disclaimer: this video is prepared for illustration purposes only. I strongly recommend that you consult with your lawyer and accountant to discuss the tax and financial implications to you before making any purchase of a property, because your individual circumstances may differ. For more tax tips, please click on the subscribe button below and visit our website. Feel free to follow us on Twitter, Facebook, Instagram, and Google+. Don't forget to like, comment, and subscribe to our YouTube channel. See you soon, and thanks for watching.